Hey, welcome to the exchange. I want to talk about what's going to happen this summer. Really, it's going to affect the U.S. stock market as well as the global economy as a whole. So at some point this summer, I think we're going to see basically a shift from a narrative from basically an inflation story to really a growth story. And what I mean by that is basically as inflation comes down, because it will this summer almost for sure. I'll show you some of the data later on. But really the question now is how do companies maintain their actual high growth rates post-COVID? And that's really the question we have to ask right now. But I pull up here. This is the CPI chart. So this is actually a measure of inflation percentage-wise, year over year. And really, you can see here the big spike is really happened in March, April 2021. So we're actually lapping that right now. So if nothing else, the base effects alone of versus 2021 versus 2022, it's going to be different. Like this summer, those high inflation levels are going to be hard to really comp on a comparable level. But inflation is still going to be here. Really, the question now is what happens next. So stocks are valued on two different things. So number one, they're valued on the actual cash flows they actually generate. So think of a stock like a machine. You have inputs, the machine itself works. You have outputs. The outputs is cash. Now what we do is number two, take that cash, put a multiple on it. So if you have a high multiple stock, it means, hey, I'm risk tolerant, overall risk tolerant for the growth and everything else too. If you have a low multiple stock, basically saying, hey, I'm risk intolerant, meaning I want my cash back out faster, I'll be paid back faster, etc. Now the market as a whole has your average multiple rates across various industries and various index funds and everything else too. Now, what's happening right now is as inflation is going up pretty high, those multiples are contracting over time. But the data should get better this summer in this fall timeframe. So those multiples should expand back out, which should be good for overall most stocks in the U.S. market. The problem's going to be later on this summer if we have basically a demand shock where all of a sudden demand is dropping and that machine itself is breaking down a little bit and the cash flow and outputs is not as much as it should be. All of a sudden you have where multiples are very high, but the actual cash that's based on is very, very low, creating a problem for the U.S. economy. So you have to ask, why would earnings miss, later this, fall and summer timeframe? But really the answer there is really 8.3% inflation. Wages have increased 5.5% roughly. That gap there, basically almost like a negative stimulus on the U.S. economy. Now, I know on a personal level, like 2%, it's not that much, doesn't really matter that much, but on a macro level for the entire U.S. economy, that's a massive amount of money. I mean, that's billions and billions of dollars, basically taken out of the U.S. economy by inflationary effects. So another thing we're seeing too is actual hiring freezes or actual layoffs themselves. So like Amazon and Twitter are having hiring freezes. I did a video on Carvana and they just had a mass layoff, for example. And this is going to continue as the summer and this fall rolls around because, companies are having that margin compression. They're also having basically a flattening growth rate, kind of this post-COVID era. So again, we'll see, but if nothing else, this basically means the total wage base of the U.S. economy itself is shrinking right now. So right now we're doing 50 basis point rate hikes basically per meeting. And really the question is, how high does it go? Or is it kind of that Fed neutral rate potentially? And like we're hearing right now between 2.5% to 3%, which I don't know. I don't think we're gonna make it that far. I mean, I think if anything, we'll get around this 2% level, kind of match the 2018 kind of levels we're in right now. But the problem is right now is as inflation slows down and really as demand potentially slows down as well too. I mean, we could have some massive deflation kind of on the horizon itself too. And if you're basically raising rates into a deflationary kind of almost recessionary economy, I mean, you can make that economy crash very hard, very fast, literally in a matter of weeks potentially too. And it could be coupled with the actual stock sell-off as well as kind of the overall consumer goods like lack of demand. So this has to be much more nervous. This is the Fed balance sheet itself. So you see right now, it's roughly about $8.5–9 trillion. Pre-COVID timeframe, we're at roughly, looks like $4.5 trillion total, maybe a little bit less than that. But we actually did decrease the balance sheet back in the 2018–2019 timeframe. We did stop in the fall of 2019 because really the economy was starting to have some issues there. It wasn't quite growing as fast. And then obviously COVID struck in 2020. And then from there, we basically printed to the moon, for example. But they actually do have a plan to unwind their Fed balance sheet. And what this basically involves is as the Treasury securities and mortgage-backed securities basically mature, basically reach their end date and they actually get paid on it. From there, basically what they do is they take that cash, just don't reinvest it. And then from there, basically pull it off the balance sheet, for example. So you see here's the plan. So you see roughly starting in June to August, it's almost like a trial period for this plan. So doing roughly $30 billion of treasury securities and about $17.5 billion in mortgage-backed securities. And then if everything goes well this summer, September timeframe hits, they're basically going to double those up to I think total of $95 billion from September 2022 to December 2023. Now, this is a long-term plan. I mean, this will shave off about $2 billion of total, basically assets itself, which I doubt they get that far because that'd just be absolutely incredible. I mean, without anything breaking and the economy going into a major recession, for example. But again, we'll see what happens with this. So let's go back to 2018 timeframe. So you see right here, it really began in the January timeframe, January of 2018. It really rolled off about $20 billion per month. And as you see here, we stopped roughly around September, October of 2019 when the economy started kind of flattening out quite a bit. But look at the federal funds rate real fast too. So you can see that same time frame, you're seeing roughly 1.4% federal funds rate, rose up to the fall time frame at roughly, it looks like here, topped out about 2.4%, really the spring of 2019 time frame. But interesting note here, so go to the S&P 500, that same time frame. So this is like December, January 2018, roughly at 2810. You go to the fall of 2019, let's see here, let's look October timeframe, 3067. So the growth rate is there. We can grow in basically a balance sheet roll-off economy though. But you see right there, the growth rate is just not very fast, not very high, just because of that negative pressure by both the federal funds rate increasing and also the balance sheet roll-off. Hey, but that's basically a roll-up of the U.S. economy for this summer and this fall. I mean, if I think a most likely scenario is, I think the Fed rate hike stops sometime later this summer, maybe early fall timeframe. I think simultaneous rate hikes with balance sheet reduction, I mean, the risk there is it's very, very extreme because at a certain point, there's so much negative pressure on the U.S. economy where it might just break it potentially too. So I think more than likely the rate hikes pause out this summer or this fall, and then the balance sheet reduction, it continues, maybe at a lower pace though too. But again, if the economy crashes, Jerome Powell will save the economy to a degree, but the question is how low it actually goes, which, I mean, I think if I had to guess right now, I'd say 20% lower at most for the S&P 500. At that point, I think politically it's just non-viable. Now, the Fed balance sheet itself, I mean, it's dangerous to have a balance sheet that large, but I mean, really they have no other choice but to maintain it, because if they unwind it too fast or too much, I mean, it's going to crash the U.S. economy. We're basically in a recession and or a deep depression. Hey, but that's the U.S. economy for the summer and this fall of 2022. I mean, there's some positives there with inflation dropping, but also negatives on the horizon are very, very big too as well. Be sure to sub and like down below. Also drop your comments down below as well too, and that's the exchange.